Well, hello there, EGA Tribe. Welcome back to another Everyday Growth Advisors webinar. We're going to be kicking off the market breakdown just like that. Another week has passed, and I hope that you guys had a great weekend. This is just a little bit of an update. Just want to update you in a couple of situations that I'm looking at and also keep you in tune with the market activity. So just going off, what happened last week. We had, kind of a pullback on the S&P 500. We had a pullback on the NASDAQ and, a dip into the very, very nominal correction here on the uptrend. We were hoping that, we would see further push up in the market. We got that towards the end of the week last week. The S&P 500 managed to clinch back a key level of support, which was the 4120 level that we were watching, and I was kind of telling you guys about. This is remains a key level for bulls to secure this week, and we will continue to see if we can find support here this week again for a bounce to the upside. Now, there are a couple of things that we would have to take note of, and I'm doing the U.S. stock market first. I'll get into the Chinese stock market in a second here, because I see a once-in-a-lifetime opportunity for this year at least, going into the next bull wave at least. So watching the S&P 500 here, there are a lot of things that are being priced in. Why this correction happened was mainly because of the market pricing in a rate hike earlier than usual because of inflation numbers. However, in my opinion, this view is slightly skewed, and I think that there are two main reasons for this. The first reason is because investors are looking for near-term growth, so they're looking into the short-term performance of the S&P 500, which has been good this past quarter, by the way. More than 90% of the S&P 500 companies have reported earnings, and Q1 2021 has seen almost a 143% year-over-year growth from last year. So we're looking at actually a pretty good performance overall from year-over-year performance of the S&P 500. Mainly, the sectors that led the growth were energy and financials, as we have been predicting for a long while since last year, which is the reason why we have been kind of harping on that for a long time. Now, investors are looking at the short-term growth of the S&P 500, which is not a good telltale sign of the economy. I think more importantly, the Fed has already, many times mentioned that they will not be increasing rates until they see inflation at a higher target than usual at above 2% for an extended period of time, right? And so I think the market is kind of pricing in a possible shock into this kind of rhetoric that the Fed is throwing on. And let me tell you why. It's mainly because the Fed has done this in the past, where they surprise the market with a higher rate or a higher rate or a faster rate hike. It has been done by many Fed chairmen in the past, and therefore the market is starting to smell bullshit, and they're trying to call bullshit on the Fed's decision. I think that this is a disconnect from what the Fed is looking at and what the market is expecting in terms of investors. And, the pent-up demand of this economy will be stronger than what we expect, which will lead to higher inflation, which might lead to a higher rate increase. However, I think the Fed will give adequate time for the market to price this in the future. So market's pricing this in ahead of time. We may see another relief rally, but this week the key level to watch will be the 4120 level, and if we do break this, then we are indeed going to be going for a seesaw between these two levels. So I think a short-term price action to the S&P 500 will be back and forth between these two levels, which will cause a little bit of a sideways movement, or in other words, hell for option traders. So keep that in mind. This is my personal belief. I am not saying that this will happen or anything like that. Remember, everything in this video is not financial advice. It's purely what I see as a possible trend. Okay, this has happened in the past before, where the market rallies, runs back, and then the market moves sideways. And the reason why I feel this is possible is because the market's gonna wait for the next month's job reports and the next month's inflation numbers. Okay. And so the inflation numbers and the job reports for next month will be more important at this point than anything. All right. The whipsaw should continue on, and we will see, possible rotations, and I've already alerted the group on what are those rotations in our Discord community for this week. Mainly, we will be looking at a bunch of different sectors, and so just peel your eyes out for this 4120 level. It's going to be very key for this week. Okay, so that's breaking down the S&P 500. Now looking at the NASDAQ here, we got a possible bounce last week on the first demand zone right here, which was, I wouldn't say it was a strong bounce, but still, a rejection here would send the NASDAQ back down to the possible bounce level here, and also back down to the 299s, where there's a gap fill here that we have to go for, sending us down in tech, further down, in this market. And I think this is still on the table. As long as we don't break and hold above the key level of 328, this may still, move to the downside. Tech may still slide to the downside, which will cause more trauma to investors. So these are things that I'm watching for the week. Tech should hold above, this key level, and if we trade between these two key levels, then we will see further upside in the future. But if we break below the support here at 316, this opens up 299 and 300 as possible downside scenarios. That's what I see on the NASDAQ. Now, a couple of things to note. Gold is now officially bullish. A break above 174 will see me enter long here. If I can validate 173 as a potential support here, this will be key level for me to take this to the upside. Looking at some far out the money strikes for next year as a swing trade, position trade / whatever you want to call it. That will be something that I'll be looking at. A pullback in energy seems very possible at this point, and so does a pullback in financials after a massive rally. Okay, so keep your eyes peeled on these two sectors as well. Okay, but however, the main focus of this video should be the biggest opportunity in this, not the U.S. markets, but what we're looking at in the Chinese stock market. And I've been mentioning about this for a long while. KWEB, which is the Chinese ETF by Crane Shares, is in a key level of demand here at the yearly low. Okay. And this market is now retraced close to 37% from its highs. And I think this is a optimal entry for long positions to enter here for the next bull run of the Chinese stock market. Okay, I know that Baba posted earnings last week, and that's something that you guys would have been scratching your heads about, because the company actually did better than expected. Year-over-year growth was almost 60%. Including acquisitions of Suncor, which is one of its companies that it acquired. And, it's just very interesting to see that the stock market will not honor that. The reason being because they got fined, right, to the tune of $2 billion for monopolistic act, right? Now, I think this is even a better reason to get bullish in the Chinese stock market, because the risk to reward ratio here is huge to the upside, but very limited to the downside here. I do not see KWEB breaking below the 6250 level. I don't think it would be able to. However, obviously I may be wrong. So don't once again, don't quote me on this. But however, I do see the risk to reward ratio opportunity to the upside here, and I think that a break and a consolidation here for a while might occur, but this is a great spot to accumulate positions for the long haul in the Chinese stock market. This happened last year as well. We had a kind of a sell-off, and then a huge run-up after that, an explosive run-up in 2020. You can see during the March crisis, April, May, and then right in May we had a little bit of a dip, and then right after that it went boom all the way up from $40 to $70, and this Chinese stock market seems, it is usually a volatile instrument. Okay, the PE ratio here and valuations for the Chinese tech companies look very attractive at these levels. The other thing that you can look at playing here is Asher, which is the Chinese mainland stocks. These are to diversify within China itself. This is just a pro tip here. You don't want to go full KWEB. You want to also diversify within the mainland Chinese stocks, which Asher has a bigger percentage of financials in its holdings. Okay, so you want to be concentrating on that as well. Remember that the inflation rate of China right now is still within control, 2%. And the central bank is doing a good job of managing inflation there. Okay, so really great opportunities here in both these markets, and I think KWeb is a great one for you to personify and take advantage of. Okay, I'm going to keep this webinar as short as possible because I don't want to run it too long. But yeah, I appreciate you watching this video and tuning in. I will be back again next week to give you another forecast and other opportunities. Not to make sure that you guys checking out our Instagram page. I've posted a watch list there for today, this week. I just posted it not long ago. So go have a look at it. We're looking at a couple of plays here. And also, for those of you that are wondering, our mentorship course is live again for signups. Go to learncompoundpro.com to sign up today. We are holding our biggest sale right now, which is 30% off on the bundle for the beginner and the technical analysis course, as well as 20% off on the beginner and technical analysis course individually. There's also an early bird promotion. If you sign up early, we will give you a 1 month free access to our Discord, which is a private group where we have signals and whatnot. So we hope to see you there, and we may this week be in your favor, and happy trading, guys. Take care, and I'll see you all next week. Bye bye.